Okay, well, welcome everybody to today's webinar on the Canada Emergency 75% Wage Program. We know that many of our clients and our friends are suffering through this historic pandemic. And all of you, I'm sure, have just been inundated with so much written material from WorkSafe, from lawyers about these government programs and provincial programs. What we wanted to do today then was do something a little different. We wanted to let you, the clients, our contacts, our friends, you set the agenda. You let us then talk to you about your issues instead of us setting the agenda. So let me introduce our speakers today. First of all, Chris Dunoffs is the head of our employment and labor practice group at Kane Shannon Weiler. Chris graduated from UBC Law School with a Juris Doctor in 2011, received his Honor Law Foundation Award, and I can tell you he's a pleasure to work with since I've joined in October. Kevin Scott. Kevin is the Kane Shannon Weiler Senior Partner and Tax Specialist. He graduated from the University of Saskatchewan Law School in 2002, and his focus is individual and corporate business tax and related issues. Myself, my name is Michael Weiler. I joined my brother's firm, Kane Shannon and Weiler, in October 2019 to become part of our expanding employment and labor group and to work with Chris. Chris and I proudly say that we have a combined 50 years of experience. I'll let you figure out to do the math and how that's broken down. So we're here today because on March 27th, the Prime Minister announced that there would be a 75% wage subsidy. And it took them over 2 weeks to dot their I's and cross their T's and come up with legislation so that on April 11th, Saturday, the government, with the cooperation of the opposition, was able to pass Bill C-14, which brought into being the CEWS wage subsidy package. Somebody asked a question about the heading in our article, what do we mean it's law? That's a really good question because what it meant was all of the discussions and what you saw from the Prime Minister and Morneau were very good indications of what would be law. But until it became passed in the legislature, it's not law. So that's why it was important to have the actual law passed. So I wake up Sunday, I've got a copy of this, and I'm thinking, well, we've been talking about it for 2 weeks. Going to be a piece of cake, just read it through, just be an easy piece of legislation. Much to my horror, it wasn't a separate act. What it is are a number of amendments to the Income Tax Act. Now, this brought me back to thinking of my days in law school where I took income tax course from Art Skase. Art Skase was a practitioner in the leading light on an expert on income tax law. He wrote the book, actually. And Art started the first class and said, look, there's 60 of you here. None of you are going to be tax lawyers because none of you are smart enough. Well, maybe the guy in the front row could be. But other than that, the rest of you are not going to be tax lawyers. But there's a good reason why you're here. Because throughout your practice, you're going to say, wonder what the tax implications are. You're going to say, I don't understand that tax issue. I better check with somebody. And that's the purpose of it. He said, come and check with an expert. So when I saw the actual legislation on Sunday, and I talked to Chris, we were very fortunate to be able to lasso Kevin to get on board and be part of this because it does require not just the employment and related issues. It did require this tax input. So we're very appreciative of Kevin's tax expertise. I also want to thank Anna, who's Chris's fiancée, and Carolyn, my wife of 44 years, who have put this program together and have provided really all the setup and technical data. A couple of housekeeping points. If you have a problem with the transmission, etc., give Anna a call at 604-961-2738. That's 604-961-2738. Now, if you have questions while we're going through this, you can use the Q&A function to ask those questions. We'd ask you to put your name on it. There's a very good chance we're not going to get to all the questions, certainly not all the questions that may be asked, but we wanted to know who asked the question because we're going to get back to you. Chris and Kevin and I are committed to following up because if your question has been asked, it deserves to be answered. So that's the reason for putting your name on it. Other people won't see it. It'll just be you and us as moderators will be able to do that. So now I have to say, we are lawyers after all. This program is intended for your general information and really should not be taken as legal advice. In large part, each case has to be decided on its own particular facts. And as we've indicated, the rules are changing so fast that what we thought yesterday may not be the rules today. So it's like having the second best hand in poker. If you don't follow up and be sure about it, then you may make a mistake in what you're doing. And some of the examples of the changes, just to name them, we all know about the CERB, that's the $2,000 giveaway. And originally, if you had any income, you couldn't get served. Well, then a lot of people said, I clean houses for a living and I'm still making $800. So what the Prime Minister said on Wednesday was, well, we're going to change that so that you can make $1,000 and still get the $2,000. He even said today, and also I think they're going to change things to allow students to get it, seasonal workers. So there's a whole myriad of changes. And that's because they're moving so fast to bring this in. They're fixing it as they go. The intention is to get as much money out there to as many people as quickly as possible. So you got to expect these changes. Apparently, yesterday the Prime Minister announced that $40,000 giveaway where you can make a loan, no interest, and you only pay back $30,000 in December 2022. That's now been changed. So now the ceiling has been raised to 1.5 million, which will again bring in more people. What's important about that is that it reflects the overall policy, which we think will govern how they interpret all of these programs. And that is, their intention was, if you're acting in good faith and trying to access this, they're going to cut you a lot of slack in how you did it and why you did it. That's my view of it. Also, the Prime Minister announced commercial rent assistance is coming soon. So there are a lot of things that are happening. And in order for you to be up to date, you have to check back with one of us or whoever your professional advisors are. I'm going to MC the program. We'll review the submitted questions. We've had some questions offered after that, and we'll take those into account if we can. And then finally, if you have questions on the Q&A, we will try to deal with those. Realistically, not going to get through them all. We will certainly get back to you. So first of all, let me just give you some overview, some 30,000 foot. I mean, the CEWS is clearly a game changer. It's one of the key elements of their arsenal to defend against COVID-19. But there are a whole bunch of other programs, and you've seen them, you've heard from us and others. They started with EI. Well, if you're affected by COVID, we'll waive that first week. And then they went to WorkShare and changed it from 38 weeks to 76 weeks. And then they created the 10% wage subsidy, which again, they're changing. Then they created CERB, which is the $2,000 one, and I've indicated that's been changed. But there are a host of other tax and other financial things that are out there. I've mentioned the $40,000 loan program. There are programs that deal with deferring taxes, GST, et cetera, et cetera, et cetera. And our point is this: even though we'll talk about the CEWS, which is the major one today, you really should check with whoever you can to find out what's out there. You don't want to leave money on the table. And guess what? The government wants you to take every nickel you can get, because that's going to get the economy going when we come out of this thing. There are also provincial items like the $1,000 giveaway, the rent subsidy of $500, and there's some more announced today. So really take a look at every program and benefit from it. Okay, CEWS. What does a 75% wage giveaway mean? First of all, please refer to our article that Chris and I sent out on Tuesday night. That may give you some more detail. But essentially, it's this. You get 75% of wages that are paid for people who are on your payroll up to a maximum of $58,700 a year, which works out to $847 a week. That's the deal, okay? Now, it's currently set for 3 months, beginning March 15th, ending in June 20th. But I want to make a point. One of the questions that was asked, they have left it open, knowing what's coming down the pike, where by regulation they can extend it to the end of September. So that's the program we're dealing with. there are a whole bunch of criteria, and Kevin will get into more of the detail on your questions, etc. But you got to be an eligible employer. You got to be an eligible employee. You have to be paid eligible remuneration, and during the relevant periods. All of these concepts are fairly detailed and are there to support the program. As noted, the money can be paid in 3 different periods, and you don't need to be working, so that somebody you're bringing back will get the benefit of it. So that's kind of an interesting thing. You have to show the drop in revenue, as Kevin will go into it a little more clearly. If you qualify for one period, you automatically qualify for the next. We don't have the specific form yet, and Kevin will comment on that, but they may have things in there that you've got to basically, say that are accurate, but we don't know exactly what will be in there. So one of the examples that they give in the government program is well worth thinking about, and I won't read it to you, but it deals with an owner of a car company in Manitoba, the 2 owners and 3 employees. And at the end of the day, they explain how the 2 owners continue to work, get the 75% of their wages, and then they get the 3 employees who've been laid off, how they're going to get full benefit of the $847, or in their case, $600 each, even though they're not working. So it's a good example, and I'll get off that. I've got to get this full screen. Thank you. So let's get started then. And we've taken the questions, we've kind of divided them up. Really tough ones we've given to Kevin, medium tough ones we've given to Chris, and I got all the underhand snowball ones. So let's start with Kevin. Kevin, before we start, I'm wondering if you could, I've given kind of the 30,000 foot, but I know that because the income tax changes, can you give kind of an overview of some of the areas that will require some more digging in order to know if you're eligible?
Sure. Thanks, Mike. Yeah, as you said, this benefit, it's the game changer of all of the response of the federal government. 75% wage subsidy. The key here is the revenue test. So essentially, you have to show a 15% reduction of revenue in March or a 30% reduction of revenue in April and May. And there's a whole bunch of different methods and alternatives you can use to show that. The first sort of variable is that you can look back to, so let's say, for example, we're looking at March and we want to prove that we've had a 15% revenue reduction. We can look back to March of last year and compare those 2 months, or you can look at an average of January and February of this year. So that's the first sort of variation. Another variation involves reporting your income on either an accrual basis or a cash basis. So again, depending on your business, that could be a real game changer. And one way you might qualify, another way you will not. A third sort of variable is if your business is part of a related group or an affiliated group of companies, you're going to have the opportunity to file on a consolidated basis, for example, which on a consolidated basis, you might qualify for this subsidy, whereas if you were going entity by entity, you would not. There's additional rules where you're part of a related group and perhaps the salary, the employees are in one company and the revenues in another company. There's rules to help in that situation as well. So the point being that there's all these different variations, and you're going to have to go through these different variations and see which way you qualify. And if you do qualify under one of these variations, you're off to the races. As Mike said, if you do qualify in one period, for example, if you qualify in March, you automatically qualify in the next period, which is great. So it's again, it's an absolute game changer, and we're going to spend, I think, a fair bit of time talking about that today. So I think that's good. We can start with the questions if you want, Mike.
Yeah, just a couple of things I'm going to add. The way the government set it up is that the people that are going to pay the money to you are the people from CRA. These are the people that normally get their hands in your pocket and take the money from you. So I think it's going to be hard for them to kind of change their mindset here, but that's how it's working out. But what's also important about it is the government is relying on people being honest. They don't have the time and the details to really monitor it. So the application's going to be made. They say it's going to be signed by somebody who has to be knowledgeable within the company. So they're going to be wanting to talk to Kevin, et cetera, or the accountants to make sure they're verifying what is accurate. And it's going to sit with CRA. So I think that's a huge situation. The other thing is CRA can decide, for whatever reason, it can publicize your name that you've applied. So, your competitors are going to know that you suffered a 30% reduction in certain years. So I'm not sure exactly what the purpose of that was. I think it was to put the hammer in the velvet hammer. But in any event, those are the kind of details that are going to continue to be discussed as we go on. So let's go, Kevin, to a couple of questions. I've kind of bundled them together. And so one of them says, I'm looking for some clarity on the subsidy available for owner-manager corporations for arm's length employees. Is the subsidy available to an incorporated individual that pays themselves by T4? And the other question that we thought was somewhat similar was one that said eligibility. They wanted to know about eligibility for non-arm's length /owner/manager partner situations. Can you take a run at that, Kevin, and see what come up with?
Sure. So the first question is sort of a two-parter. The question first says, hey, I'm an owner-manager and I've got arm's-length employees, and clearly the subsidy is going to apply to arm's-length employees. And then I think the second half of the question is saying, what about the owner himself or herself? And yes, the subsidy will apply, keeping in mind that the owner-manager had to have paid him or herself salary in the pre-crisis period. So there's an absolute requirement for non-arm's length employees. They must have been employees previous to the crisis, and essentially the subsidy is going to be limited to 75% of that baseline remuneration. So that's the remuneration received between January 1st and March 15th of 2020. So 75% of that, up to a maximum of $847 per week. So that's sort of the difference for non-arm's length employees. You definitely had to have been an employee prior to the crisis. Second question, just dealing with owner managers in general. They will be considered non-arm's length. Again, they must have been employed prior to the crisis starting. A few issues we're seeing thus far is how they're receiving their income. So we've had some questions where they don't receive remuneration. Instead, they receive dividends. Unfortunately, the rules don't look very favorable for that situation. We've also had some questions where the owner-manager pays themselves once a year at the end of the year. Again, that doesn't look like it's going to be favorable as well, because the rules are pretty clear that you have to have been paid again between January 1st and March 15th. So there's definitely a tightening for non-arm's length employees. But yes, generally speaking, the subsidy should be there for both arm's length and non-arm's length employees.
Great, thanks, Kevin. Chris, and I'm just going to take these and bundle them. I've got two that I want to bundle. One is this. They want to know about reducing hours and layoffs. Do you need to provide a notice letter or a period? The other one that tied to that, two more. As an employer, we have had no choice but to lay off 7 of 18 employees to date, which is kind of a common situation, I think, for a lot of us. We are only able to service the exterior suites and buildings these days, huge cut in revenue. The remaining employees who are on payroll, we're trying our best to keep them as busy as possible to maintain their regular pay. we do show a loss of 15% through the second half of March, and we'll be on pace to meet the 30% loss each month moving forward. And although there are 7 layoffs, do we still qualify, they ask, for the new CEWS with the remaining 11? And also, do we need to bring back the other 7? And or can we give the other 7 who remain on layoff or furlough, can we give them the subsidy?
Thanks, Mike. So let me start with the first question. So I think before you even consider reducing hours and doing layoffs, you want to take a full, close look at the CEWS program and see if you can make that work for you before you make any significant decisions with your workforce. If it does come to reducing hours and doing layoffs, you have to start by looking at the employment agreement, the workplace policies, and any collective agreements that might apply. Is there something in there that gives you the right to reduce hours or to put people on a temporary layoff? In most situations, there won't be any such document. So the best way to protect yourself in that situation is obtain the employee's agreement and consent to make the change that you want to make. And, in the case of a layoff, you may be able to make it a little more favorable for the employee by keeping their benefits on, keeping their health benefits on during the layoff period, or registering for the EI sub program where you can top up the EI. Those are ways to create legal consideration to have an enforceable agreement to make those changes and have the employee consent to them, which will protect you from a claim of constructive dismissal or claims for severance pay down the road. And I think when you're doing this with your employees, it's important to try and have the mindset that we're working through this together, we're in this together, and we're just trying to get through this as best we can to try to bring the employees alongside and go with the changes that you need to make to help your business survive. If you do come to an agreement with your employees about reducing hours or layoffs, you want to document that carefully. Make sure you have a letter, a signed agreement, or a letter from the employee. But be careful, because the more formal you make something like that, the more likely the employee is going to go and see a lawyer. So a real balancing is necessary when you implement these kind of changes. And finally, if you can't secure the employee's agreement and they won't agree to the changes, if possible, try to give as much notice as you can of the changes, because giving reasonable notice of reduction in hours may be a full defense if an employee decides to sue you down the road. So that deals with kind of reducing hours and layoffs in general. Going to the question, the second question, where there were 7 employees that had been laid off and 11 employees that had stayed on. So that's a great question. And the short answer is there's no obligation to bring your entire workforce back in order to be eligible for the CEWS. You can claim the subsidy for wages paid to the part of your workforce that continues to be on your payroll, even though others may still be on layoff. So if those 11 employees remain on layoff, you can still qualify for the CEWS for those 7 employees that you've managed to keep working. But in this situation, you might want to consider, can you put those 7 employees back on your payroll, maybe even at a reduced wage? And if that reduced wage is 25% less than the pre-crisis wage, you can actually claim back 100% of the reduced wage that you pay to those employees. So it's really more of a flow through from the federal government through you to those employees, and that may benefit them more than simply staying on layoff and staying on EI. And I think that's one of the primary policy objectives of this program, is to re-engage employees with the employer, even if there's no work to be done. Just getting them back on payroll it helps re-engage them, and as Mike said, hit the ground running once this thing is over.
Great, thanks, Chris. First of all, can everybody hear me? I guess there was a problem with my microphone. Just a couple of things on that. What a lot of our clients are doing, they expect to be back in the game, and so they've been forced by the pandemic to make the changes and lay off people. Many of them have kept benefits on. So if you've got employees that are on layoff and they're entitled to benefits, many of your programs will allow you to do that. As a matter of fact, some of them will allow you to extend it. So it's something to look at. But the key is that you're trying to keep the employees connected. You got to remember, the employees are more scared than you are. And it's good to have that connection with a kind of a positive potential. This will come to an end and we can get back to some sort of normal. So if you can do the flow through, in my view, and you get 100% rebate, that's not a bad idea if you're intending to start up again in hopefully the near future with those people. And you should also check with the employees. Some of them may get more money out of EI than they're going to get out of the wage subsidy. So just check with that and see, it allows you to go one-on-one with your employees, which I think is a useful thing to do at this time because they are looking to you. And if they continue to look to you as the solution maker, I think that's a good thing. Okay, I get a question. How does a wage subsidy work with salespeople that have half their income based on commissions? Basically, when you're looking at remuneration, it is defined under the Income Tax Act as basically anything where you would be making the normal deductions. But it doesn't include, for example, severance pay and some other things, stock options and stuff. So that includes commissions. So commission salespeople, although they're paid differently, will be eligible, in our view, for the CEWS. How do you calculate it? My sense of it is that you take the period January 1st through March 15th and exclude any periods of 7 days or more where they've had no remuneration. And they just average it. They do it under the Employment Standards Act going back 8 weeks. So it's kind of the same thing. Again, I leave you with the idea the government is trying, from a public policy point of view, to give as much money to as many employees as possible. And so when you're doing these calculations, just give your best effort to work it out to a reasonable amount that's defensible. So the person signing off from the application, again, has to verify it. And so we keep the notes, we keep the background. You don't have to file all your background material, interestingly enough, but they're relying on you to have that if they ever come knocking. So the other thing I want to mention that I forgot to mention in the overall, they have to be on payroll and you have to pay them, and then you get the money back. So that's a period of risk that we think will be minimal, because we think that if you're acting in good faith and there's not a lot of screwing around, they're going to massage the rules to give you the break. It'll be hard for them to come back after people. But if you play games, they probably will. Okay, so I'm going to go back to, I'm going to give Chris another question if I can. Chris, a long-term employee has just transitioned from medical EI, let me take that off, to LTD, 1 year entitlement with a review every 3 months, okay? So they've gone from EI medical to LTD. Can the employer lay off the employee at this time without being subject to legal or human rights issues?
Thanks, Mike. So in this situation, we've got an employee that's already on medical leave. They've obviously been on medical leave for some time because they've gone through their 15 weeks of medical EI, and they're now transitioning into long-term disability. So presumably they're continuing to be disabled from working. So because they're already on medical leave, I don't see any practical benefit to laying them off at this time, because the employer's not going to gain anything from that. They're not paying anything on their behalf right now. And there's a significant risk, a human rights risk, that if you treat that employee in a negative way by laying them off, which is considered an adverse action under the Human Rights Code, they could come after you and claim discrimination and say, you laid me off because of my disability. So really in this situation, I see no reason to lay the employee off. Just have them continue on the medical leave and go through the LTD process.
Excellent. So I'm going to give myself another easy one. Are layoffs appropriate for individuals who cannot work due to being high risk for serious illness, and the employer is able to find appropriate alternate work? Good question. one of the things that you now have to take into account with the myriad of changes, and I'm assuming this would be a provincial employer and not a federal employer, therefore governed by the Provincial Employment Standards Act. Because as you may recall, if you've seen our recent newsletter, the provincial government amended the Employment Standards Act in order to give job security for people who are absent because it's related to the pandemic. And it operates if you are on this leave of absence. It's like a maternity leave. All of the obligations about bringing them back, and comparable employment, and you can't discriminate, and reverse onus on you to say it had nothing to do with the pandemic or the leave. All of those principles apply, but they're a very limited group. For example, those that have been diagnosed with it and under the instructions. People that are in quarantine or self-isolation, but not self-quarantine because they decided to do it, but more, the provincial health officer has ordered them. Here's one that would likely apply in these circumstances, in my view, given the bona fides of the employee's concerns. The employer, due to the employer's concern about the employee's exposure to other, has directed the employee not to work. And I think that would apply in these circumstances. So the person is laid off in the sense that they're not working, but they are, in my view, under a medical leave. So when you're doing the ROE, you fill out not A, shortage of work, but you put D, medical leave. And I think that's right. D, medical leave. So I think they're kind of in a different position than maybe other employees. So they're not technically laid off, but they're going to get all the EI benefits. So I think that's it. Chris, anything to add to that?
No, I agree.
Yeah, okay. So we're going to go back to Chris. Is the 75% wage subsidy, is it a separate assistance from a previously announced 10% one? I had some other 10% questions here. What are the requirements in order to qualify for the 10% versus 75%? And then another question, does the 10% wage subsidy also require that corporations have a loss of gross revenue of at least 15%? So those are three questions, and I mapped them together because they all said 10%. So maybe you can just do the overview and then try to give some answer to those questions. Thanks.
Sure, thanks, Mike. So the 75% CEWS program and the previously announced 10% subsidy program are two separate and different programs with different eligibility tests. So the 10% program is really geared towards smaller businesses, and there's a limit. It's limited to corporations, individuals, or partnerships that have a taxable capital of less than 15 million in the preceding tax year. I have no idea what that means. I'm sure Kevin does.
Would have been Kevin's question.
But the 10% program does not actually require a decline in revenue in the same way that the CEWS does. And so it's much broader, but it's more limited in what you can claim. So you can claim essentially 10%, but it's limited to $13.75 per employee. And it's limited to a maximum of $25,000 per employer. And that's based on wages paid between March 18th and June 19th, 2020. So again, it's a slightly different qualifying period than the CEWS. And it works a little different because the 10% subsidy, it's not an actual payment from the government, but it's gained simply by holding back the 10% amount from the income tax remittances for those employees that it applies to. So it's important to note, though, that if you qualify for both programs, any amount that you've already deducted under the 10% subsidy will reduce the amount you receive back under the 75% subsidy during the same time period. So you can't get both. But we do recommend looking into the 10% right now because it is something you can do now to save costs. And, given that you may not get the benefit of the 75% subsidy for some time, it's worthwhile to do the 10% now.
Great point. A couple of points that I'm going to make on that. First of all, this is a really good example, in my view, of the building block approach the government is taking to these various programs. when they came out with the 10% one, I think all of us sort of said, $1,600 an employee, maximum employer 25,000, like, and going through the hassle, et cetera. So I'm not sure how many employers really jumped on that and took advantage of it. But it did have some differences, because when they came to the CEW, 75% wage subsidy, they had to bring in other rules. So, for example, the 15%, 30%, which don't apply for the 10% rule. They had to come in to put a lid on it. Otherwise, we'd definitely be bankrupt as a country. So there are some changes there, but it shows you that they wanted to avoid an overlap. They wanted to, it's not double dipping. If you're getting the 10% and you get the 75%, you're going to have to deduct the 10%. The other thing Chris makes a great point of is that the 10% was fast, because all you did was don't send in money. The way that the CEWS has been set up is that it's, and Kevin will correct me if I'm wrong on this, but I think it's set up as a tax overpayment. The government owes you money as a CRA, and so they pay you. That's why there's this delay in when you get the money. And Chris is right that the 10% may be important for you to get now, and then down the road they'll just even it out. So that's good. Okay, Kevin, there's a question here about, if we take advantage of the subsidy plan, do we have to pay it back? How do we show proof of revenue deduction to meet the minimum standards? And what does the subject use to will this be subject to a CRA audit at the year end? Do you want to take a run at those?
Sure. Yeah. So, the answer is no. You do not have to pay the subsidy back as long as it was properly, calculated and everything was on board. Obviously, if the revenue wasn't calculated properly and you can't show a 15% reduction in March, for example, then yes, you will have to pay it back. And also, if you've undertaken certain transactions to artificially lower your revenue, you could be on the hook as well for some penalties. So, the answer is no, you do not have to pay it back. As far as what you have to show, you should keep records, showing that decline in revenue between the two periods. You should keep records as to what you paid your employees, again, pre-crisis and currently. The application itself doesn't require you to submit that information today, but you should keep that on hand. Again, going back to my previous point, the most difficult issue here is trying to figure out what your revenue loss is and which sort of alternative methods you're going to use. And again, there's a lot of different methods, accrual versus cash. Again, if you're part of a corporate or a corporate group of companies, you're going to look at different ways of calculating that. And again, you're going to look at different benchmarks, whether it's, looking at the months last year for comparison or looking at January, February. That's going to be the most difficult part of this.
Yeah, Kevin, just on that, one of the points is that when the government's trying to give more flexibility, so for example, allowing consolidated companies have consolidated statements, they can either go the biggie with the entire group, or they can pick off separate subsidies, and all of that was intended to broaden the scope of who can get it, right? What does create the issue? If you've got the simple question, I got one company, 80% of my revenue is down. It's sort of like the duck theory. I'm not going to need a lot of rocket surgeons to tell me that I qualify, right? But I think where our clients are going to find a lot of these interesting questions that they need to look at all relates to what you tax people told us we had to do, to have a separate company, and then we're employed by a separate company, and then we got a family-owned company, and we got a family trust. Like, all of those things have to make it more complicated. The point being, if you look at them and look at them properly and get the proper advice, on the face of it, you may say, well, we're not entitled to it. But then you may find, with the flexibility built in, yes, you are. Unfortunately, it may take you more time and effort to get there. But and I think that's the underlying fact here. They wanted to give as much money away to as many people as possible. I keep coming back to that policy thing. It just makes this a bit more complicated, especially as there are amendments to the Income Tax Act. We have to be careful. Okay, I'm going to take another question just because we need a light interlude. This question is interesting. It says, what does an employee's obligation to mitigate financial loss look like during a pandemic? For example, an obligation to agree to a work share, agree to a temporary layoff to seek emergency benefits, the obligation to agree to reduced hours that otherwise be considered constructive dismissal. How will the pandemic affect the reasonable notice period for those with the wrongful dismissal claim after and during the pandemic? All good questions. Chris has touched on this a bit, but I want to give you my thoughts about one of the big issues employers faced when all of a sudden a whole bunch of people are laid off, right? We had to take it out of the pandemic concept and realize that in the normal course, if you lay off somebody, absent an agreement, pretty clear, it's probably a constructive dismissal. So the employee can say, hey, that's the same as firing me. I'm out of here. I want damages for reasonable notice, etc. They also may have looked at the Employment Standards Act provincially that said if you lay off somebody, a temporary layoff, 13 weeks out of 20, it's automatically back to the first day a termination, in which case Section 63 individual termination severance pay and potentially Section 64, which are group terminations. And these are really big numbers when you're talking big numbers. So my advice and Chris's advice is that we think the concept, this legal concept of frustration of contract, where the courts, human rights tribunals, and indeed even the Employment Standards Act build in a concept that says, look, if your inability to perform the contract, i.e. provide work, if it is absolutely impossible for unforeseen circumstances to do, it's not that you have dismissed anybody, it's just that it's gone away. The substratum of the contract has gone away, okay? So hard concept to prove in employment. We see that in wrongful dismissal mostly the other way, where the employee is absent for a long period of time. The employer is arguing that they didn't dismiss, the contract just came to an end. Under the statute, Section 65(1)(d) builds in that concept, says there's no severance pay owing under 63 or 64. Don't worry about it if you can prove this concept. Impossible to perform the contract due to unforeseen or circumstances. The problem there is, all of a sudden your major customer goes away. Are you going to be protected? No. But my view is this: the pandemic is the pandemic. It is the entire enchilada, and that's going to govern everything. How can a court say that my contract that required, I had to lay off 50 people because I got no work immediately? My restaurant shut down, or I got an order, or I just, I'm a dentist and I can't perform my work. How can the courts, who themselves are shut down, I mean, you can't get access to the courts. A criminal's not going to get his day in court. So it's going to be hard for them to say, yeah, well, we weren't subject to that, but you are. I mean, I think that's the problem. And so all you plaintiff lawyers running around out there looking for the great wagon of wrongful dismissal cases, you're going to be in for a bit of a fight. One final point on that: governments across the land are taking a look at their employment standards. Alberta is looking at extending the temporary leave to 6 months. Many of us think that just puts out the problem down the road, because 6 months, if you're not back up and running, you may be hammered. I think the fact that people are back on wage subsidy, I think that protects you. I think that people that agree after a couple of months, if you're carrying on benefits, for example. So I think there's a lot of arguments in favor of employers to fight off these potential claims. So Chris, let's go back to you if we can. How does the CERB, the CEW, so the CERB is the $2,000 one, the CEWS, that's the 75% one, and EI benefits, how do they affect individuals just moving into or coming out of maternity leave? Are they eligible for EI or CERB? Can the employer return an employee from such leave and then apply for CEWS? Those type of questions where you're getting the overlap. Gives you an opportunity to also kind of talk about how they interact. Thanks.
Thanks, Mike. So generally, an employee that's coming off maternity leave will not have enough insurable hours to go back on a claim immediately. So generally, you need at least 600 insurable hours of actual work before you become eligible for another EI claim. So people coming off of mat leave are generally not immediately eligible for EI benefits if they're laid off. And I think the government recognized that would have the potential of working a very significant injustice for employees that are just coming off mat leave and then have to be laid off due to the pandemic and wouldn't qualify for regular EI benefits. So that's one of the reasons behind the CERB, which has much broader eligibility criteria. An employee coming off of mat leave, even though they wouldn't qualify for regular EI, would still qualify for the CERB because there is no insurable hours requirement. The only requirement is that employee earned $5,000 or more in the 12 months before the application is made or in the entire year of 2019. And maternity leave benefits and other EI benefits actually count towards that $5,000 requirement. So therefore, employees coming off of mat leave do qualify for the CERB. In terms of the second question there, if you have an employee that's coming off of mat leave back into the workforce, there's no reason why the employer couldn't claim the wages paid to that employee under the CEWS. You just have to be careful with the timing. One of the criteria for an eligible employee under the CEWS is that essentially they weren't eligible for the CERB. So you have to look at whether they were paid remuneration for 14 consecutive days or not. But so long as they meet that criteria, there's no reason why you couldn't bring someone back onto your payroll from mat leave and claim the subsidy on those wages.
Great answer. And again, bear in mind that the CERB is, as we speak, under amendment. And so, again, you got to check back when the person's coming back and dealing with it. But again, using your common sense as to what the purpose was. We want the person back from mat leave, not just going off someplace. We want that person back on payroll, whether they're working or not, whether they're back full-time or not. They may want to come back part-time. And so these other programs are there. Bear in mind, though, that the EI part of WorkShare, where you have one of those WorkShare programs that EI tops it up, or the sub-plan, all of that will be clawed back under the CEWS 75% wage subsidy because, again, they're not wanting double dipping in a lot of these programs. Kevin, here's a question. Do the Canada Emergency Wage Subsidy and the CERB benefits, the 2001, do they apply to employees of private corporations, including the employee who owns the voting shares? Could you just go through that one?
Sure. Yeah. Again, as far as the 75% wage subsidy, yes, it does. The owner-manager will be considered a non-arm's length employee. So again, you have to take a look at their baseline remuneration. You got to look back at January to March 15th. And as far as the CERB, yes, it will apply as well. It was set up for owner-managers. They broadened it to include that group as well.
Okay, good. And I guess there could be more details in that type of situation. For example, when you've got these employer-owned companies paying themselves, et cetera, it may be a question, as you said in your introduction, that if they're getting it at the end of the year, if they're paying the dividends, all of those things that are set in place already have to be looked at to see whether or not, in your particular case, you're going to be covered. The question one for me, a nice easy one, what happens if the benefits go away in June? Are they looking at extending the program? The answer is yes. The legislation remember when you're passing an act, you have to have the government there doing it. They did it with reduced numbers by agreement, but you have to have a sitting of the legislature to pass it. However, regulations can be promulgated by the government. And back in the old days of the Employment Standards Act, if the number of exemptions that came in regulation undercut the act to a large extent because they didn't have to go through the legislature and have debate over it. Similarly, this program, with the government anticipating it's likely going to go beyond June, specifically provides that it may be extended to September 30th by regulation. And I think that's going to happen. So the safety net will be kind of there. And also bear in mind for your employees, if they're 3 months on the wage subsidy or have come off EI and are just sitting there, but now on the wage subsidy, that kind of puts a hold on their EI benefits, I think, Chris. And so that 2 months doesn't count against their EI. So they can go back on EI if they have to. And so, again, it's trying to get that continuity of compensation to the point where we think the country is kind of on its ability to come back. So that's a long answer for a short question. Chris, let me see if I got in my job bag or jar here a question for you. We are a restaurant which is closed, our operations due to COVID-19. Most of our staff are laid off March 17th. Our employees typically accrue their vacation pay in any given year. Is vacation paid that was accrued prior to March 15th, 2020, and is now being paid out during the claiming period eligible for CEWS?
Thanks, Mike. Yeah, that's a great question. I think the short answer is yes. Vacation pay does fall within the definition of wages or salary in the Income Tax Act, and it's been interpreted that way. So it is included within the definition of eligible remuneration. And if you're paying vacation pay that's been earned during the qualifying period prior to March 15th, 2020, I see no reason why you couldn't claim the CEWS on those wages.
Perfect. Thank you. Kevin, if we're paying directors management fee, and that's in quote, I don't know exactly what that means, rather than as employees, can we still use the wage subsidy program, the 75%? And it goes on, it says, with the CERB, that's the $2,000 program, we have to show T4 sum for employees for 2019 to be greater than, I can't remember, it's 5,000, isn't it?
That's right.
I can't remember. Most of our employees were laborers who would work on a day-to-day basis and not for the purposes of taxes to be on payroll. Does it add up to the minimum requirement? Is there any way around this?
Sure. So the first one, yeah, it's interesting. Like they say, management fees, and in my world, management fees are usually paid to a company, and of course, a company wouldn't qualify for this. If, on the other hand, they're talking about director fees, I believe that would be eligible remuneration. Directors are considered employees. So it sort of depends on what it is. If it's director fees, I think it would. If it's like a management fee, or it probably does not. Sorry. And then the second question is more about the seasonal. I think the CERB. And yeah, the question had in it 50K, which I think they meant to say 5K. So hopefully their employees are already earning more than 5K, and it's not a question anymore. However, if their employees are making less than 5K, then yeah, I think they still have a bit of a problem. As Mike, you said at the beginning, the feds have talked about expanding the rules for the CERB for seasonal employees and part-time employees. So hopefully there'll be some relief there, but my understanding right now is that they still have that $5,000 requirement. So that and if they don't have that, unfortunately, under what I know right now, they would not be eligible.
Now we're running down to the wire. I knew we wouldn't get all the questions asked, but that's okay. I want to point out I'm the only one that's touched my face, so bad on me. Chris, I want to ask you this question. I don't think we did this one. I hope we haven't. What's the best process for employers if someone refuses to work as they feel it's unsafe for them to do during the pandemic situation? In this case, their pastor told them it was unsafe. What are the rights of the employer in those situations? And a companion question we thought was, we've laid off our employees. Now our business starts to pick up. We require a few employees to come back to work. However, most of them refuse to come back, would rather stay on EI. What can we do as a company? Can we terminate their employment with us so we can rehire new employees? Do we still need to give them notice from the previous layoff and caused a factory shutdown? No time to give them notice. So how do we do it? Can you answer that?
Okay. So in terms of work refusals, an employee does have the right to refuse unsafe work under BC's occupational health and safety laws. And basically they need to have a reasonable, keyword reasonable, cause to believe that performing their work would create undue hazard to the health and safety of themselves or to another person. And so the WorkSafe occupational health and safety regulation is a really giant regulation, and it's very complicated and detailed. But it does set out a very specific procedure for dealing with work refusals in terms of the investigation that the employer needs to do and any reasonable measures that need to be taken to reduce or eliminate the workplace hazard if one does indeed exist. So in cases of work refusal due to COVID-19, I think erring on the side of caution and respecting the work refusal is important until you can do an investigation and determine what it is that they're concerned about and if indeed there is an issue there that needs to be remedied. Now, that being said, if the reason provided is clearly unreasonable from an objective point of view, or you've gone in and done an investigation and satisfied yourself that the workplace is safe, maybe with the assistance of a professional if needed, you are within your rights to require that worker to come back into work and make that a condition of their employment. Now, if they fail to do so, you can do one of two things. You can decide to keep them on an unpaid leave until they feel comfortable to come back to work, or you can consider discipline and take the position that either you've got just cause to let them go, or that they've abandoned their position by not coming in when you have a safe workplace for them to come back to. And in that case, if you have orders to fill and work to do, you can hire new workers that are willing and able to come in and do the work. Another note of caution on that is there's something called a discriminatory action, and that's provided in the Workers' Compensation Act. And basically, if a worker makes a legitimate work refusal and raises a health and safety concern that's not unreasonable, the employer cannot retaliate against that worker by treating them negatively, by disciplining them, lowering their wage, or terminating them. And if they do that, they may face what's called the discriminatory action complaint. So when you have work refusals, you just have to be very, very careful, and I'd recommend seeking the advice of counsel in most cases.
Yeah. So a couple of things there. So that's a situation where the employee, you want them back and they're not coming back. But the other flip side is when you only want some of them back, you got to be a little careful that if they all want to come back, and you're now picking and choosing, you just got to be careful because it could be human rights. I don't see anything in the CEWS that says I can't choose whoever I want to bring off EI or put back working. So, but I think just common sense tells you don't want to, at this stage of your business, be phoning us up because you've got a human rights complaint or you've got some other thing. And the other thing to bear in mind, bouncing all these balls, are the amendments to the Employment Standards Act that give COVID-19 leave. If they fit into there, you can't be doing things, including you may not be able to reduce their salary when they come back. So all of those kind of interesting questions. One thing that I didn't answer, I don't think, in that two-part question was what happens if there's a legitimate wrongful dismissal, like it doesn't fit into all of the little things that we're talking about. You just fired Ralphie and he's out the door. And you don't have a written employment agreement that limits his damages. The question was, well, what about the notice period? And the answer is, I think the maximum notice period of 24 months will still maintain. I don't think that's going to change. Supreme Court of Canada has made it pretty clear, and Ontario has made it clear it's not going above that. But here's what's going to happen. In 1980 and 81, for those that remember, BC Hydro let go 100 engineers all in one day. And you can imagine how specialized that skill is and how likely those guys were going to get a job. As a result, a bunch of wrongful dismissal cases came out called Unsafety, and they were all done by the former Chief Justice, Al McKechnie. And he gave a pretty high level of notice period, if you go back and look at it, based on the 4 criteria of age, length of service, availability of similar alternate employment, et cetera. So, yeah, it's going to pump it up a bit because the person's not likely going to get a job, and then, of course, be really difficult to mitigate. The other case is a case called Hunter and Northwood Pulp, which basically said he was let off in the 80s in the forest industry when it was in the dumps. And the Court of Appeal said, well, we can take economic circumstances into account to maybe bump up the notice period, not to bump it down, but to bump it up. But it can't be given undue influence. So the answer is yes, it's probably going to be higher numbers in the go. So folks, I have a few minutes after 1. I know that we wanted to keep it to 1 o'clock. We've covered a lot of the questions. What we do promise we will do, I've got a list of questions that came in today, and we've got the number of chat questions for those that have left their name on those. And I assume, Anna, we can keep those in some form, printed form. We'll get back to you. Now, I just wonder, Chris, do you have any quick closing comments?
Yeah, no, just want to thank everybody for coming, and we will answer your question. If we didn't get to your question, you pre-submitted it, or if we've got an additional 20 questions that were submitted during the presentation. So we will get back to you within a day or two on these questions. And yeah, just thank everybody for joining us.
Okay, and thanks, Chris. And Kevin?
Yeah, same. Thanks for the great questions, and of course, we're going to stay on top of any amendments and any new sort of benefits that come down the pipe. So, and good luck to all the businesses out there.
Yeah, and finally, one of the questions I had was, who the hell's going to pay for all this? Well, my view is, if a fireman doesn't want to worry about how much water he's putting on a fire, he's just going to put it on. And that's what we're doing. And, I think there will be a light at the end of the tunnel here, and it won't be an oncoming train. Unlike the 30s when the government was restricted from opening up the pockets, that's what they're doing now, pumping the liquidity. But this one's different. We've got to get people back. It's not going to be the same normal, but it will be a new normal. So stay positive. But in the meantime, really work hard to look at all those programs and maximize how much the government wants to give you, because it's all our interest to have that. Everybody be safe. Don't touch your face, by the way. Thank you. That's it.
Thanks, everyone.
Cheers.